Hello, welcome to everyone. Thank you for joining us today. We really appreciate your time, considering that we are really close to the Christmas time and everybody is extremely busy. So we really appreciate your time. And we have the pleasure to introduce today our collaborator, Adam Harris. He will provide copy training for us and he will carry on the webinar during today. He will explain the market vision from these current years and different strategies. Okay, so let me give you a quick review from him. He's experienced enough. He started in trading since 2008, and he's been providing technical analysis for different revamp platforms, right? So please check, feel free to check his profile. Let me give you as well a quick review from our broker, our trading conditions. Okay, Fortune Prime Global, as a broker, we have a regulation under ASIC and also Vanuatu. We have a different type of trading accounts for different traders. So we have the standard accounts with a zero commission, minimum deposit $100, minimum lot size 0.01 lot, and spread is very low from 1.3 pips. Leverage up to 1,500 for Vanuatu, and EA available. Execution type, the most important, really high speed execution type ECN, hedging allowed, and also scalping is allowed. Okay, so from our ECN accounts, the commission is $3.5 per lot and 0.0 pips. Okay, same conditions, and let me show you our copy trading system. So from our copy trading system, you can follow different traders. You can check their performance and select which is the most suitable for you. You can copy or disconnect the copy trading at any times, and you can swap between them, and all your funds are ready to be withdrawn at any times. Also, we have the man accounts available. Please check our website and feel free to join us even in demos to check our fastest execution and our credit condition. So we will be really happy if you just test us as a broker, as your trust broker, okay? So for withdrawal and deposit method, we have a stick paid, okay? We have, let me show you, okay? So we have different funds, deposit, withdraw. Let me show you. You can use USDT. We have our wallet. We have credit card, stick pay, perfect money, bank transfer, and with a very quick withdraw and deposit. Yes, here we go. I leave you with Adam Harris. Thank you for joining us.
So just for everyone who's watching, my name is Adam Harris. I'm a chief market analyst. What does that mean? It means that I provide high-level market analysis across the board for obviously exchanges and high net worth clients around the world. And obviously I'm very happy tonight, very honored tonight to be providing some of my own content exclusively to you guys on through with Fortune Prime, and Hugo is my host, and thank you, Hugo, very much for inviting me to speak this evening.
Yes.
So I really appreciate it. I would love for this to be interactive, so if you have any questions, don't be shy. Just feel free to ask the questions as we go. Just put it in. I've got the questions. I've got the little chat open on my right hand side, so I've got two screens so I can see everything, and I can see if you have any questions. Excuse me, and I will just obviously answer those as we go. You don't have to wait till the end. You can just ask questions as we go. So tonight's excuse me, tonight's topic is building a day trading strategy on the platform, which is MT4, and obviously today's date is 19th of December. So one of the things that happens is, obviously this may be happening with most of you as we head towards Christmas this year particularly. Usually what happens is most people are working until about the 20th, 22nd, the weekend before Christmas, and then they go on holiday. It seems that this year I've noticed that a lot of people are actually leaving a little bit earlier, because it just seems to be the case. Everybody I talk to, all the meetings and all the calls and everything I schedule, everyone is already kind of on holiday. So if that is the case for you, then good for you. The purpose of today's webinar is actually really to do two things. It's first of all to kind of wrap up what has happened in 2023, and also to kind of make a plan as to what to do in 2024. Excuse me. So what Hugo and I would like to do, obviously, is to create, for example, a series of webinars where we provide both market analysis, trade ideas, and obviously also strategy, building a strategy, an actual technical strategy to take advantage of potential trading opportunities in the markets, as well as talking about which markets are offering those opportunities. So trading is a learnable skill, ladies and gentlemen. It doesn't always seem like that. I know it seems a bit intimidating, but it is a learnable skill, not that different from learning a new language or learning to play a musical instrument or learning to play a professional sport. It's not that hard. There's a lot of basics that you really need to master. So that's really a big thing. You need to learn which basics you need to master. Then you need to master those. That takes practice and repetition. And then you start to find that you get a feel for it. Okay, so that's really what I would like for all of you to get out of the series of webinars that we do. And obviously in bits and pieces for each of you, those moments will happen as we go along. So on the agenda, I'm going to give you a brief introduction to who am I. You might not know who I am. I'm not necessarily anyone special. I am a fund trader, regulated fund trader. I also obviously trade my own capital. I trade for family and friends. I'll tell you a little bit more about me when we have a look at the next slide. We're also going to talk about the difference between trading and investing. You need to know the difference. Okay, you need to know the difference. And they're not the same thing. They occur in the same marketplace in the same way that soccer or football and rugby, for example, are the same. They occur on a field. We've got goalposts. We've got two opposing teams. We've got a ball that gets moved around, but they're not the same, right? The rules are different. The goalposts are different. There are subtle differences, and you can't play rugby in a soccer match, and you can't play football, obviously, in a rugby match. So it's the difference between that. We'll talk about also building a case to take a trade. So trading is an evidence-based activity. We are building up a case to either not take a trade or to take a trade. So one of the sayings that I have is something called rule it out. Rule it out means to make sure that you've identified where the risks are and that you've ruled those out, and also to make sure that you're not imagining a trade. You're not thinking while the market's bullish when it isn't. So those are technical skills we need to talk about. I'm also going to introduce some strategy rules here. All right, these are the first sort of set of strategy rules that I started to, when I applied these rules, I started to become consistently profitable. Prior to that, I was trying all kinds of different strategies. I was all over the place. Tonight, what I'm going to do is make a case, present to you a specific approach to engaging the markets that is most likely the best for the average new trader. All right, there are not an infinite number of ways of making money in the markets. There's a lot, but not a ridiculous amount. There's probably a few hundred different ways of making money in the markets. And yes, we each have to find our own way, but you'd be amazed at the number of people who work off the same basic idea. Okay, so let's start with that. Let's start with an approach that works for the average trader to get you going, in case you don't really have an idea as to what you want to do. And then we'll talk about what's next. What are the other opportunities that are for you? So who am I? I'm an independent trader. I'm also a chief market analyst. That is a relatively respectable role in the city in London. I'm based in the city of London. Currently, I'm just south of Canary Wharf. And then from January, from next year, I'll be sitting on the coast. I'll be moving to the coast. So we've got a beach house. And I predominantly tend to trade in the mornings. So I might look at the UK session as a day trader. I'm looking at the 1 minute, the 5 minutes, and the 15 minutes. I'm looking for the same type of setup, but I'm just looking for an entry on one of those 2 or 3 different time frames. And then I might look at the US Open. So for example, the last 3 or 4 weeks, I've had if almost no chance to really day trade. That's because I've just been extra busy because we're moving. I've got to pack things and I'm doing a whole lot of stuff that's impacting my average kind of day. And therefore I'm running around doing all kinds of other stuff. But in a perfect week, in the ideal week, I have time in the morning and time if I'm based in the UK, time to trade the US Open, which is from around about 12:30 till about 2:30 p.m. when the US comes online, and there's a spike in the activity in the markets. Lots of movements and therefore potentially opportunities. And then often I'll look at the end of day, where I'm looking at the daily chart, where I'm looking to see if there's any end of day signals. I'm going to take you through that. I'm going to show you, here's an opportunity on the lower time frame that would have been a good for a day trading opportunity. And then I'll show you on the higher time frame what they would have been like as an end of day setup, because there are different trading routines is a better way to put it. There are different trading routines. If I have a day job and I can't always be at my desk for trading, then I might, and while I have that day job, I might be looking for an end of day trading opportunity. In the UK, you'd come home 9 o'clock, 10 o'clock before you go to bed, look at the markets, look for trading opportunities. Excuse me. Look for day trading opportunities on the daily chart across all the different markets. So the way that I'm approaching today, this strategy is a robust one. It means that you can use it in currencies, commodities, and the indices. All right. So in other words, you're focused on where the market moves are. That is probably one of the sort of, there was certain things that I learned when I started to become consistently profitable. And the secret isn't necessarily which instrument you're engaging with, but it's the type of market conditions. Certain market conditions are safer. They provide a higher probability of success. That is a really big game changer that most people don't understand. It'll make sense when we talk about the difference between trading and investing. So that means that I'm a day trader, a swing trader, and I also manage my own stocks portfolio. But managing my own stocks portfolio is not a full-time job. Believe it or not, although it might sound like I do a lot, it's maybe 90 minutes in the morning, 90 minutes in the afternoon, and 30 minutes at night. And then in between, I'll be doing what I'm doing now. Might be doing a webinar, walking the dogs, going to the gym, doing various other things. And the stocks portfolio really is only looking for opportunities every few weeks. So that might mean that every 1 or 2 months, I'll be going, okay, there's a setup, and I'll be either adding to the portfolio, in other words, buying stocks, or maybe closing out a position. It really isn't a full-time job.
So, Adam, can you search for stock opportunities?
Yes. So,
I mean, how did you find? I mean, you have any tools for searching stocks?
Okay. So now that's a great question. Now, because I'm predominantly a technical trader, so a technical trader, what does that mean when we talk about looking for stocks, for example, is that we know that as a technical trader, if we're in a bull market, there's a lot of stocks that are going to perform well. Okay. So for example, we know, generally speaking, Microsoft is going to do well. Berkshire Hathaway is going to do well. There's going to be what the expression is. There's an expression called a rising tide lifts all boats. And it means that if the market is bullish, a lot of companies are going to do well. So the first thing we want to do is establish, are we in a bull market, which we are now. Again, when I get to the charts, I'm going to have to show you that, but we are in a bull market. And that means that actually most of the stocks that are good stocks will actually start to rise. And then I can start to look for those individual stocks. So the first thing I want to do as a filter, as a way of scanning for opportunities, is ask myself, is it a bull market or bear market? And most people don't do that. So once you know if that's the case, then you would start to look through individual equities to see which ones are looking good. So for example, Amazon or whatever, we'll have a look at the ones we've got. I've got a whole lot here that I would take us through. Then we've got, so I'm a trend trader. What does that mean? It means that I want to focus mostly, I want to put most of my energy into markets that are moving. So market is either, it sounds silly to say it, it sounds obvious, but most markets either moving or not moving. And I want to focus on markets that are moving, because if they're moving, first of all, if they're moving, it actually is, it sounds odd, but they're safer, because again, when they're moving, it means whether they're going up or down, it just means that there's a direction. The market has an idea of where it wants to go. And I'm looking on average. You can't just pick and choose how much profit you want to make per month. But I have noticed from experience that if I do what I do and the market is moving and I get the opportunities, my results tend to be somewhere between 2 and 8% per month. Okay, I've had some really good months. I'm going to show you a live trading account. And so we've had some big swings in the market. But here's the thing. What I want to happen for you, which happens for me, is that if there's a big move in the market, so you come home and gold has been climbing for a week, that you got a piece of that. It's very frustrating for me and other people when they go, well, actually, no, I thought gold was going to go down, so I lost money. I'd much rather that we're in a place where people feel that they are in tune with what the market is doing. Okay. And also, okay, so let's just finish this up because I'm spending too much time on this slide. And so I've got various slides, various different clients that I discussed that for. So let's quickly talk about the difference between trading and investing. Why does it matter? All right, why should it matter? You would think that they're not really that different, and you would think that if they were very different, it would be everyone would know about it. But actually, I've discovered from experience when I work in the City of London that many people who are investors think of themselves as traders, and people who are traders think they're investing. They've never stopped to really kind of clarify. So let's talk about the difference between these. So here's the thing. If you are an investor, and it's important because if we imagine we have an investor hat and we have a trader hat, they are two different people, two different personalities. They behave differently. They do different things to get different results. If you're an investor, you can only, the reason you're an investor, and we'll talk about it historically, the two best ways, just if we keep it very simple, very general, two best ways to make money on your investments is either put it into stocks or put it into property. That's like safe. Historically, that's been a good way to do it. You could put it into the banks, into a high interest account. That's another thing you can do. Sorry, excuse me. When I'm talking, I'm swallowing air, so it's just catching up with me. So you can put your money into a bank account, which earns interest, high interest. Okay, so that's one way of doing it. But if you want more than that, you could put it into buying a piece of property or buying property, renting it out, that kind of thing. So you get rental income and you get growth, or you can put it into stocks. Those are both historically valid, traditional ways of where the average person can make more money on their savings. Okay. So here's the thing, because it's an investment, it's usually time-based. We don't need the money. That's the whole point. We have this money, whether it's $5,000 or $50,000 or whatever, we have the money, we don't need it right now. We want to put it somewhere where it's going to make some money. So usually we put it away somewhere. And the thing is that often what happens, and this is a generalization, as soon as we decide, okay, I'm going to put it into stocks, we put it in immediately. We don't go, well, I have to wait. Maybe, Warren Buffett would always say, well, for him, it was about finding the right company at the right price. So even if he found the right company, he'd have to wait for the right price. So he might have to wait 8 months to get the right price to buy it at. Usually we don't do that. For individuals such as us, just normal mortal retailers, we just go, look, I want to put it in as soon as I put it in, because the sooner I put it in, the sooner it can start to go to work for me, and the sooner I can get some growth on that. So that's usually what we do. So then we just throw it into the market. Let's say it's the S&P 500, for example. And then our idea is that we just leave it there. So the longer that we can leave it there, the more likely it is to increase in value. And obviously, if we don't need that money, we will never take it out. So these are very important things. Let's just recap what that is. Usually it's money that we don't need. It's spare cash. Okay, usually it's money that we can put away for a while. We don't worry about the exact price of the market that we put it into. And usually it's a time-based thing. It needs time to increase in value, but it has to go up. So we need that particular market to go up in value. If it doesn't go up in value, then that's a problem. So properties tend to go up in value. Stocks, the right stocks, most stocks tend to go up in value. So that's why they are the safest type of approach for that traditionally. And then if we don't need it, we might not take the money out. That's a very, very different thing from trading. Trading, ladies and gentlemen, is when we need to earn a salary at the end of every single month. So trading means we have to take money out of our account every month to pay our bills. So if you work backwards from that, it means that you must be making money probably every single week. All right, and in order for you to do that, it means that you must be closing out your positions. You cannot take money out of your account if you haven't closed those positions. So this is a way of thinking about it. So in working backwards from that, what traders are usually doing is traders are usually looking for opportunities that will last a few minutes to a few hours to a few days, not a few months, not even a few months, maybe 1 or 2 weeks, but usually hours or days, maybe a week. So it's a much more shorter term approach, and it has to be closed out. This is a very big distinction. Every single trade that a trader takes has an exact, precise entry to the pip. Their stop loss will be in a specific place to the pip, and they will have an exit planned. In other words, every single trade you take will get closed out. You can't get married to it. You're not going to date it. You're not going to spend the rest of your life with it. You are going to have to close it out. That is a very, very big thing. And that changes what we look at and what we're expecting it to do. So traders are looking really for much, much shorter opportunities. And therefore, with the slide that's in front of us now, I'm looking for my draw tools. There we go. I lost it. So traders tend to be operating in the trenches, doing these kinds of shorter term moves, and they might take a very specific entry and take the trade, close the trade out, and then kind of do that. So it's kind of like you decide you want to supply your family with fish. You want to eat fish. You want to feed your family. So if you're an investor, you want to create a fish farm to grow the farm, and then one day you'll start feeding your fish, or you'll start feeding your family, I beg your pardon. But as a trader, you don't have that luxury. You have to go out there and catch fish immediately. You've got to catch those fish every day to feed your family. It's a different kind of thing. Excuse me for 1 second. I'm just going to open my door. It's getting a bit stuffy in the office. I'll go and close it again. But yeah, so this is the reason this is so important, ladies and gentlemen, is because so many people I know think that they're the same thing. And so they take a trade, they decide to go, I don't know, they decide to go long on gold. They decide to buy gold. And gold is going down and down and down, and gold could go down for years. And because in their mind, they're convinced that gold has to go up in value. So what they've done is they've taken an investing idea and they've done a trade on it. So I want you to think about that. I want you to always ask yourself, are the actions I'm taking because I think that this is an investment for 10 years? Or is it as a trade because I think it's going to go a particular way just for the next few minutes, the next few hours, or the next few days? And once you master that aspect, you will see an incredible transformation in your results. Because that means that even if I am bearish on the US dollar, let's just say that I get this idea in my head, I think the US dollar is just going to tank. As an investor, that might be one thing, but as a trader, I also understand that yes, for 2 weeks it might go down, but then for a week it's going to come up, and then for the next 2 weeks it's going to go down. But it means that my brain has allowed me to accept that it'll go down and then come up maybe and go down, and then if it's coming up, like, that doesn't change my longer term plans. It means that I trade around that. So that's a very important distinction, and most people don't know that because no one's taught them that. No one's told them that. So let's talk about how we're doing for time. Okay, we're good. Building a case to take a trade. So taking a trade it's an evidence-based activity. The market can only, ladies and gentlemen, the market can only exist in one of two states. I know this, I'm simplifying stuff. It isn't so much that the ideas are hard for us to understand. It's difficult for us to take action, because sometimes we override what we're seeing. We don't accept what the markets are doing. So the market can only do one of two things. It can go sideways like this, where it's going up and down and up and down and nothing, or it can move. So it's either not moving or it's moving. And if it's moving, it's either moving up or it's moving down. Those are the only things the market can do. So it doesn't matter what the fundamentals are. It doesn't matter what someone thinks and what George Soros is doing and what JP Morgan says and what, it doesn't matter. The market can only do one of those two things. It's either moving or not moving. And if it's moving, it's either going up or down. And this sounds like a simple idea, but a lot of people have a huge amount of difficulty with it. Okay, so the first exercise we need to do is to look at a market and ask ourselves, which one of these is it doing? Because if it's not doing anything, if it's not moving, we should stay away from it. Why should we stay away from it? If it's not moving, it could be that way forever. It could be that, well, not forever, but for weeks, for months. It doesn't matter. If I'm a buyer or seller and I get in here, I could go up or down. It could go the opposite way. In fact, the problem is that there's no one in control. Both buyers and sellers a lot of buyers and sellers have left the market. So when you have a trend, you have more people engaging in the market. The volume increases, the volatility increases. When it's ranging, no one's really involved. No one cares about it. As many people as possible have left it. Some people are there, some people aren't. Some algos are trading it. Don't worry about the algos, but they're there, but they're not bigger than the humans trading it right now. We need to know that, because again, it's a waste of our time and money to engage in markets that don't really go anywhere. Excuse me. And there we go. I'm choking on my own drink. So whereas if the market's moving, then we actually, this is where it becomes safer for us, excuse me, to engage in it, because this can actually move from one place to another. And we only make money when the market changes its value, whether it changes it to the upside or the downside. So this is something we really want to, excuse me, that's embarrassing. As I was drinking, I also inhaled, which is a big mistake. So we want to focus on, excuse me, price, levels, trend, and news. Price is really the most important thing as well, because before, look, for example, now, you can get news updates on your phone all the time, and you can go to certain websites and they're just giving you news updates all the time. But if you go back, excuse me, if you go back 20, 30 years ago, we would get a newspaper maybe twice a day, in the morning or at night, or just once a day. And that was it. And the markets were moving plenty then. They moved just like they moved a lot. So my point here is that having more news now actually doesn't make the market move more. We're just getting more news. We're just getting constant updates all the time, but the market is still moving anyway. So what that's forced us to do, or it makes a lot of people do, is that they think the news is really the clue to what the market's going to do. But the market isn't going to change its direction every single time. It's not actually that random. If it's going sideways, if it's like this, then it feels a bit random. Once it's trending, it generally has where it's going. And most people, once they see that, big institutions, they'll start to add to that. So we're trying to basically determine if the market is moving or not moving. And so price levels, if you go back before computers existed, so you go back to the 1960s, the 1970s, and before that, you go back to 1896 when the Dow, the 30 in the US, the Dow Industrial Average was created by Charles Dow, which was the 30 biggest market cap companies at the time. And that was shipping and rail and transport. It was very big. I mean, that's almost 100 years old now. And back then, those markets were not moving on the news at all. So the first thing I want you to understand is that the news is not the biggest driver of the markets. The markets move, and the news reports on what causes the moves, and then people sort of interpret that back to front. And they think that the market is depending on the news, but actually the news is often reporting on what the data is, which the market has already taken into account. So I'm just saying, like, we want to weigh that a little bit less. But if we go back and we use something such as gold, so we look at gold, and gold had a price of whatever, $800, for example. Oof, that's a terrible $800. This is the thing, $800 there. And then before that, it was sort of $750. Now, what happened was, excuse me, before the charts, I'm so sorry to keep coughing in here. Before charts existed, people would be looking at a ticker at an exchange, and they would see 750, 750, 751, and then it would go up to 755 or 760 and come back down and go back to 750 and then go back up to 770. And what they noticed when they were in the stock exchanges, in the trenches right there, they noticed that these prices, certain prices tended to be like round numbers, or 25 or 50. They tended to be numbers that the market stuck at. And this happened for lots of different instruments. So when they then started to print these charts in the 60s, 70s, 80s, and on, 90s, when computers were coming around, you could see certain levels were significant. So if you ask me, Adam, what are the most important bits of information? What's the most important information that I have on a chart? I'm going to say to you, well, it starts with price levels. Price levels, this is not a secret. This is obvious stuff. It's practical stuff. Everything has a price level, because even if you are a big, let's say you're a dealer at a big institution.
Recording. Now, good.
Okay. All right. So I'm just going to carry on from where we were. We stopped halfway, and I'm just going to carry on from where we were. So price levels are really very significant, almost more so. So let me kind of put this into practice with you. Let's go ahead and have a look on the platform. let's go have a look at a few things. So we'll look at gold, and again, we can look at it from historically. We can look at it, over time, and you can see that certain levels. Excuse me. So if we go like here's 1700, we can go down to say 1600, which is around about here. These are sort of loose levels that the market tends to respond to. So here, here's sort of 1500, and so we often find again. If we go up to 1800, we can see the market is roughly responding here. So we can see these areas the market tends to find support there. So it doesn't always have to be precise, but these round numbers, you must understand that fundamental investors and people who take orders and place these in, they don't often look at the charts. They're looking at numbers. They think, gold is overvalued at a certain number, or, undervalued or overvalued at a certain price. And then they'll have orders from their clients, or institutions will place orders at certain price levels. So when we're a technical trader, when we identify these levels, we can see them visually. We can see where those levels are significant to the market. And everything is an underlying market. For example, I often hear there is a mistaken belief that gold is a hedge against inflation. That's been said so often that everybody thinks it's true. And it's absolutely, may have been the case 50 years ago, but it definitely isn't the case now. So, case in point, let's just go in here. I want to quickly add something in that's missing into my thing over here, and I don't need this, so let's get rid of that, and here we are. But during this entire period, sort of over here, we had Russia invading Ukraine and inflation going insane all over the world because it was post-COVID. Gold just lost its value. So it was during this period that gold sort of lost its value. And so that was it literally went down. And the reason for that is not because gold isn't even necessarily a hedge against inflation, but that was the dollar doing the moves. So one of the things we need to remember, for example, just using gold as an example, gold is used in our mobile phones, it's used in our satellites, it's used in technology, used in jewelry. Gold has a massive historical market use other than just as a hedge against inflation. So it really isn't that. And so this is important because we need to, when we have ideas like that stick in our head, we take actions on that. So there are people that then bought gold up here because they thought, well, inflation's going crazy, it's a hedge against inflation, and they lost a lot of money. And they potentially bought a lot of it. So whereas the difference is that we want to be focusing on what the chart is telling us. So if you're ever in a situation where you have to choose between what you're seeing on the chart and what you're hearing in the news or some idea, if the chart is not doing what you think it should be doing, then the idea is wrong, the chart is right. So you need to adapt. And that's a very hard thing for some people to do, but you need to do that. So we need to look at levels and trend and news. Now, let's go and have a look at our strategy
how
rules.
do you interpret the last chart from gold regarding the inflation, for example, in 2021, for example?
So if we go to the weekly chart, and let's go in and let's go ahead and let's put a line in here that works on, so here's January. This is January, there we go. That's January 2022. We can see price went up, hit the all-time highs, and then we can see that until, excuse me, this is sort of until December, there we go. So this is sort of January here. And so it moved up and down, didn't really do anything. The point is we had massive inflation, the most inflation we've actually had in a very long time. And gold didn't really change its behavior in accordance with that. But actually the big thing that happened here, and this is worth mentioning, is this big move to the downside here. If we go ahead and we bring up euro dollar, we go to the same weekly chart, and we look at it, we get the same big move down that we had during that period. When we go ahead and we have a look at, the indices. So we have a look here at the Dow, go back to the weekly chart. We get the same thing that happened last year. So what is the thing that caused the stock markets to move lower, that caused the gold to move lower, indices to move lower, currencies, majors against the dollar to move lower? We can see this. If we go, for example, and we have a look at, say, Aussie dollar, and we go back to the weekly chart here, we can see for that same period over here, it moved lower. If we look at Kiwi dollar, we can see for that same period, kind of moved lower. And so really this was the dollar that was driving the move in that particular case. So one of the things we should understand is that, first of all, let's just say that so that it's been said. The US economy is the biggest in the world. Now, there was a period when China was catching up, and everyone was convinced that China is going to overtake it. But today, the US economy has taken off massively. China's economy has shrunk. So China's economy is now 60% of the US economy. So the US economy is still the biggest one. And at the end of World War II, 1945, the US possessed 95% of the world's wealth. So the US economy is absolutely gargantuan. The US dollar is used in 90+% of all transactions on the planet, including crude oil, gold, commodities, major commodities, currencies as well. So when we look at euro dollar, we're not just looking at the euro against the US dollar. The US dollar is also being moved in the US stock market. It's being used against gold. It's being used against certain commodities. So we need to understand there's a really big cog in the economic system globally, which is the US dollar. And then we have other little systems as well. So once we understand that, we can recognize like that is actually the biggest mover. And it isn't always moving. Sometimes the US dollar is not doing anything. Sometimes it's not doing anything. And therefore gold going up would be gold moving up. But sometimes when that US dollar, such as it was in in 2022, it was moving, and it was just moving everything else around it. And the reason for that was last year, there was fear and panic. Russia invaded Ukraine. There was inflation, all these various things. And so everybody just looked to the US dollar as that. All right. We didn't know that was going to be the case. We could see it. We could see the market was moving to it, and big institutions started to do that. So we didn't know that was going to be the case. Nobody knows that. Nobody has a crystal ball. Big institutions, big hedge funds can also make mistakes, right? They can misread the market. If you're going on certain websites, you'll see, for example, Michael Burry, who was one of the best predictors of the big short. He was right about that. He's lost massive amounts of money. He was expecting a massive bear market last year, which wasn't as bad as he thought it was. It's recovered faster than he thought it was. And JP Morgan and all these different institutions have misread the markets entirely. So big institutes and big markets can do that. What we need to do as retail traders is think of as the market as the big fish, that's the whale, and we are the little fish. We just in their shadows. We just go wherever they go. So that's why we have to trust that if the market is going down, it's going down, and if it's going up, it's going up. We don't need to really overthink why. Eventually, we'll find out why. They'll be like, well, this happened and that happened, and that's why it went up. But we don't need to worry about that too much. Okay, so we're going to go through the strategy, and we need to talk about these different items. Okay, and I want to keep an eye on sort of how long we chat for, because just in case we get cut off again, I want to wrap this up before we go. So the first thing on our strategy, and this is the weather conditions I was talking to you about. So this is optimal trend. So what is optimal trend? Optimal trend is when we can see on the chart a trend that is very nice and healthy. And I'm going to go and show you a good healthy trend right now. So we can look right now, we can see currently, we want to be trading also in line with what the market is doing. We can see here, it's a very nice healthy trend. So healthy trend has a particular look. Think of it as a heartbeat. So if something is doing this, if that's your heartbeat, if someone's measuring or listening to your heartbeat, that's very erratic. That's not a good thing. But if something has sort of got a very steady move to it, whether this, and by the way, everything here is the same on the 5-minute chart, on the 4-hour chart. If it's nice and steady, it's a good, healthy sign. Whether it's up or down, the heartbeat itself is nice and healthy. You can see here, there's parts over here where the trend is very nice and strong and healthy. And this is actually not that bad. There's some really nice, decent structure to it. What does that mean? Like here it's very choppy. Here it's a little bit choppy, and here it's a little bit choppy, but then it sort of smooths out. So there are different times when the market is a lot clearer about what it wants to do. And it's more like a flock of birds. There isn't someone in there that understands what everyone else is doing. There isn't like a big institution that knows what you at home are doing and they know everything you don't do. That's not true at all. Big institutions do not know what you are up to. They know what they're up to, and they have to trade against other big institutions. This is another misnomer, another myth. Big institutions have to trade against their competitors, are the other big institutions. We are the small fry. Okay, so we don't really make their lives better or worse. Right? They compete against that. We just trade in their shadows. So this, and as I said, they can make big mistakes. And if you don't really believe me, just go and Google, look up big hedge funds that have closed down, that have shut down because they're mid-race stuff. Look at Kathy Wood's ARK. Her ARK stuff, she continually gets out of markets buys in at the top when they're doing really well and then bails right at the bottom, and then they just recover. Nvidia, she got into Nvidia at the top, got out to the bottom. She made a rookie error. Okay, so I'm just saying that fear and panic and making mistakes, no one is necessarily immune to it, meaning that's the part you have to master. Once you master that, then you become immune to it. But I'm just saying, don't get in your head that somehow the big institutions know stuff you don't, because no, if you start to read about it, you'll realize they can make mistakes just like everyone else. Okay, so here we can see what does a really good trend look like. This looks great. If you go down to the 4 hour, you could just see here that this is what we refer to as an optimal trend. So an optimal trend is a trend that is generally rhythmical and looks beautiful. Okay, so we can go and have a look and see if there's a few others. I'm just going to throw a few charts in here. I actually want to go have a look at a few currencies. So let's just see if there's anything over here. Let's bring this up here. There we go. I'm just draw tools up there. Just want to go and have a look at a few of these. Okay, that's a pretty decent trend to the downside. It's not bad. Okay, you can see it's clearly heading lower. So the first thing we need to do on our list is find a good trend. So let me show you what's not a good trend. Let's go find something that's absolutely shocking. You definitely wouldn't want to engage in it. That's not great. That was pretty good. Let's see what else. Not great. This is terrible. Shocking. That's okay. That's okay. This is just garbage. You can't do anything with that. Let's see what else we got. Same thing again. Let's go look at a few others here. Euro Aussie. This is, although it is trending lower, it's horrible. Although it is trending lower, it's very, very choppy, and it makes it tricky to engage in. So we're looking for stuff but I'm looking for something specific that is just definitely not tradable. Okay, for example, right now, there's nothing tradable here. This was largely a trend to the upside. This is moving a little bit down. This is not going anywhere. This is where we are stuck at the moment. So this is not tradable. And so what we want to do is, it doesn't matter if we're looking at a 4-hour time frame or a daily or a weekly, we want to be able to determine if a chart is where it's at now, if it's worth us engaging in. And it doesn't matter, by the way, and this is really important, it doesn't matter if it's gold. It doesn't matter if it's an index. It doesn't matter if it's euro dollar, because if it's not engaged, if we can't engage in it, if it's going sideways, then right now it's not worth our attention. It doesn't mean that we can't keep an eye on it or set an alert, and if it breaks out, then we can get involved. But there's nothing happening there. And people tend to go, well, you know, there's a war out and there's inflation, we should engage in gold. If you're not seeing it happen, it's not happening. Okay, these are physical orders that are going into the market. We want to engage in those. Okay, so that is what we refer to as, these are certain markets you would stay away from. The next thing on our list is the moving averages. So the actual moving averages aren't necessarily that important. I've got a couple of templates here, which I've created. So I've got candles and MACDs, I've got moving averages. So let's do this. So what I've done here is I've added in a 50 and a 20 and a 10. Nothing special about them. They are simple moving averages. You can change them to exponential if you want, but a 50 and a 20 and a 10 work just fine. And I'm going to show you this. You can see with your own eyes that they work just fine. So whenever you have a really good trend, patch like this, where it's just trending up, you will see, if you think about it, you always see the 50, 20, and 10 in this particular formation. So you will see 50, 20, 10 price in an uptrend. In a downtrend, 50, 20, 10 in price. That means the trend is established on a couple of different time frames. So it's established. The other thing you'll notice is that the moving averages, the 10 and 20 here, acts as like a train station. So if price is a train, goes away, comes back into the train station, goes away, comes back into the train station, goes away, comes back in, goes away. Here it goes back in a little bit forward. It's a little bit of a deeper correction. This is actually this correction, and there's a bigger picture happening here. So there's waves within waves. But here you can see when it takes off, comes back, takes off, comes back, takes off, comes back, takes off, comes back, comes off. So lots of potential trading opportunities. So why we use the moving averages is, first of all, they help us establish trend, and they help us determine if it's the right time to get in. Because if price is trending, where do we get in? Well, the good news is there's only two places you can get in. Just keep an eye on the time. There's only two ways you can get into a moving market. Is on a pullback or a breakout. Okay, so when it breaks out to a new high here, breaks out to new high or on the pullback. So that means this area here becomes the best area for you to ideally get in on a moving market. Get in this area here. And the worst place for you to get in is after that. Anytime other than that becomes the worst time. So when we look at these, yes, we could get in on the breakout. Let me clear this up a little bit. Yeah, we could say, okay, well, that was a consolidation. There was a breakout chart. We could get in. Or we could argue that this is a pullback. That's a pullback. We could get these pullbacks. Anywhere we get these pullbacks within a trend. So then this is important because actually we also need to be thinking about a target. As soon as we get in, we also need to be talking about where we put our stop loss. Do we put our stop loss behind these swing lows? Those are market structures. And also, where do we take profit? Do we take profit at 2 to 1 or 3 to 1? So here's the thing. I'm going to give you a big secret here. The most sensible go-to strategy for the beginner trader to take on board is to target 3 to 1. Okay, what's known as 3R. 3R. So what does it mean? Well, 1R is your risk. So 1R is your risk, whatever that is. Is it 0.1%? Is it 1%? Is it 2%? It shouldn't be 2%, it should be 1% maximum. And in your first 100 trades as a beginner, it should be 0.1%. So you'd have a pullback and you'd find your particular candle pulls back into the moving averages. You'd be looking for a particular candlestick that's nice and bullish, one of these nice bullish candlesticks in an uptrend. You'd be looking for your entry 1 pip above that and your stop loss 1 pip below the low. And you'd be targeting 3 times that as your average trade. So we get a pullback here, any of these bullish candles, stop loss there. And again, you'd be targeting 3 to 1 as your average trade. All right, so that's your 3 to 1. That's your R is getting in here. And then your risk is going to be about 3 times that distance. That's just a sensible approach. Here we go. Here's our entry there, stop loss there, or stop loss there, entry there. And targeting 3 to 1. Okay. Sometimes you get in here. Sometimes you'll be asleep, so you don't get that entry, but you wake up and you get that entry if it's on the 1 hour or a different timeline, for example, or time frame. So you're targeting 3-1. So for newer traders, trading with the trend, targeting 3R, meaning the R is your risk in your account, 1% or less, which should be that for your first few trades. And that is determined where's your entry and your stop loss. So if your entry and your stop loss, and actually I think we should have this in a separate webinar when you talk about risk management and leverage and calculating position sizing. We shouldn't do that today. But if that is 20 pips, then my target is going to be 60 pips. Okay, and if my risk is $100, if that's my budget for that trade, if that's 1% of my account, then I have $100 to put over those 20 pips. Okay, which works out to £5 a pip. That's called position sizing. We should have that as a separate discussion. Okay, so that's our moving average fan. And then we've spoken about it now, this dynamic buy and sell zone. This is this organic 10 and 20 moving averages that acts as some form of a sort of a pulling a train station for price action. In a healthy trend, in any healthy trend, very nice, you will find the 10 and 20, that train station, that becomes the location where entry opportunities into a trend are possible. Okay. Doesn't matter what the market is. Let's go look at the S&P. We can see it putting back into these areas, and there's a breakout here, and it goes in, takes off, goes in, now it's just sideways, and then it takes off. But again, even here, pulls back, takes off, pulls back. So 10 and 20 becomes that beautiful train station. That's a really good place for us to look for an entry into a trend. Candlesticks. We're looking in an uptrend. We're looking for bullish candlesticks. So generally speaking, price will pull back. That's a bit of a bullish candlestick, but actually it's a very nice little breakout here. That's a nice, beautiful bullish candlestick. That's a bullish candlestick there. That's too big. It's too big for us, and you wouldn't get that. There's a potential bullish one here and a potential bullish one here. Nice little green candlesticks on the way up. There's a nice little breakout there. Look at that. That's beautiful. And so we get these very nice little bullish ones. In this case, it would have been potentially a losing trade because you'd get in here, it would go up, trigger you in and stop you out, and then take off. That happens. So you get statistical. There's no such strategy that gives you winning trades all the time. But you want a strategy in a strong trend. If you're using this approach, you should have, out of every 10 trades you take, you should have 6, 7, 8 winning trades, maybe even 9 or 10 in a really good run. But you'll still have losing trades. You can't avoid those. So we get optimal trend, good quality trend, moving average fan. We get that dynamic buy sell zone, which is the 10 and 20 moving average area. We get candlesticks. We're looking for bullish candles in an uptrend and bearish candles in a downtrend. So support resistance is really about taking profit. If I'm looking at a chart and I want to get in, and I'm looking at something, for example, euro dollar, I can see there's a major resistance there. I can see it here because I can see that reaction. The problem is that if I take a trade here, because you can see the moving averages here, we've got 50, 20, and 10. And if I happened to have taken any sort of setups in this area, the problem is that there's a level right here. So I want to make sure that I'm taking profit ahead of those levels. Now, sometimes I'm going to see a really great setup, but the next major resistance level is so close by that it can't be a 3-to-1. It's got to be a 2-to-1, for example. So it doesn't mean that we can't take those trades, but we don't want to take trades where there's less than. I shouldn't say 1-to-1 to the next level, but there's less than 1.5-to-1 up until that next resistance level. If that is the case, we want to wait until we get past that level to take maybe a break and a retest and a continuation. Or if it's going to reject and go down, then I'm going to wait for a break and a retest and a continuation down. So there's going to be a setup there, or there's going to be a setup there as the market moves. When it's moving, obviously, when it's moving. So we use support and resistance areas to identify how much potential profit there is on a trade. We look at that on the daily or the weekly. We look at those major levels to see if they're there. Also, we should target 3-to-1 or the nearest major support resistance level. So we do want to know where those are because the market, as I said, moves from price level to price level, up or down. And usually once it's broken a price level, it's usually going to move down to the next price level. And so we can capture a piece of that move. And this is a personal thing I like. I recommend taking some money off the table at 1-to-1. So why do we do this? Well, first of all, this is trading. We're looking for an immediate short move. Let me give you an example. So we have this beautiful trend. So we have a major support level here and a major resistance level here. Price is broken through, boom, breaks through here, starts trending. Beautiful, beautiful, pulls back. We see a beautiful bullish candlestick here. And we'll talk more about candlesticks in a subsequent session where we can talk about price action and candlesticks. But we see a beautiful bullish candlestick. So we can put our entry here, stop loss here, and potentially take profit here. Now we've got this beautiful behavior, very bullish pattern, nice and calm and rhythmic, big level here, price moves from one level to another. It doesn't really matter what this is. It doesn't matter if this is gold or euro yen or pound Aussie or oil. It doesn't matter. If this is what we're seeing and these are the major price levels, probabilities are that it's going to go from this price level to that price level. Probabilities are like it'll do that 70-80% of the time, and that's what we're really benefiting from. So if it looks nice and healthy and it's a nice bullish candlestick, that actually means that the move itself so far is very nice and healthy. And that actually adds to the idea that it's going to keep going. And then we work out, well, if I can get 2-to-1 out of that, so that's 2R, should I take the trade? Yes, because it's greater than 1.5. So it just has to be better than 1.5, 1.5-to-1. Like on our average trade. On our average trade, we want 3-to-1 if we can, 3R. So that looks good, and that is a very usable strategy. This is the first strategy that I started using that tied together all the different things I knew and just calmed my trading down. But most importantly, it stopped me from engaging in markets that weren't going anywhere. So if we go and have a look, let's see what else we got here. So if we go, because we're coming to the end now, if we're going to have a look at the different markets, let's go to the daily here. Now, it is a funny time of year. I completely agree. It's a funny time of year. But if we have a look at where we are on the market, so let's look, here's euro dollar, then let's look at sterling. So we look at the daily, there's an uptrend in place. It's battling a little bit here, but it's pulled back. There's a bullish candle, there's the moving averages, it's pulled back, looks good. So probably in this case, it'll continue up higher. Then we have a look at euro dollar. Euro dollar is testing a level of resistance here, but it's pulled back, it's taking another run at that level, fine. Let's look at dollar CAD. Dollar CAD's in a downtrend. The problem is that it's already left the train station. So I can't really engage in this just yet until it comes back to the moving averages. But at least I know which direction it's going in. Then we have a look at Aussie dollar. So Aussie dollar is clearly trending up. Beautiful. If we could get just pull back to this area, to this test this level of support resistance and keep going. Great. Let's look at euro yen. This one's a little bit trickier. In a downtrend, but it's reversing. It's starting to go up. So I'd stay away from that. Not as obvious. This is also a mess. It's all stuck within a range. It's messy. Aussie yen is messy at the moment as well. It's in an uptrend now, but we've got a level there. It's like it's super messy. Kiwi yen, again, all of these are very messy. Let's go look at something else. Euro Aussie. Euro Aussie's now started to trend down. Look at the 50, 20, and 10. So I'd be looking for potential shorting opportunities. So again, here, there's nothing going on. It's on top of the moving averages. They're crisscrossing. It's all over the place. It was an uptrend. Now it's come down. Now it's bobbing all over the place. This is an example of a chart. You just give it a miss. Euro Swissy. So Euro Swissy is also a bit messy. Came down, sideways, then down again, then up and down. And actually, it's a little bit like a range at the moment. A little bit sort of range bound at the moment. There's the top and the bottom. Messy. So you want to focus on the markets that are not messy. Don't trade something because your friend says, well, I bought Tesla or I bought gold or I did this or that. Get into gold if it's going up, buy it if it's going up, sell it if it's going down. That's what a trader is doing. It's not, we're talking today was purely mainly focused on trading, not investing. So if someone says to you, well, what do you think about gold? You can say, well, in the monthly chart, it looks bullish. So in the longer term, yeah, it looks bullish. But right now, maybe it's struggling with this level of resistance and maybe it's going to go down for the next 3 months. So longer term, I'm bullish, shorter term, I'm bearish. You can do that as a trader. You can do that. It's allowed. You're allowed to do that. It's very important for your account that you're allowed to do that. Okay. Just as one last wrap up, I would say, yeah, just remember that with gold, it went for its entire life. It went all the way up to here, 2011, without really having a big drop in price. Then it had a big correction, and from 2011 until 2019, nobody wanted to know about gold. So it's 8 years, nobody cared about gold. So if gold can take a hit and nobody cares about it for 8 years, any market can fail or any market can correct. So don't ever get in your head that any market is bulletproof because gold can take that hit. So anyway, here we go. Now we're testing these all-time highs, but it looks relatively bullish. So there we go. I'm going to let's just come back to the particular presentation. So what I wanted to do, excuse me, to wrap up was, first of all, tonight, I'm going to try to improve your confidence by also clarifying, are you trading versus investing? Get you to realize that if you're investing, there's certain markets that you can buy and hold that work really well. But if you're trading, you need to be a little bit more, you need to take different actions to capture that profit. You can't just assume a market's always going to go up or it's always going to go down. You need to understand that if you're capturing it, it's because you expect it to only go down for a bit or only go up for a bit. When you accept that, your results, you become more profitable immediately. I want to talk about a particular strategy where we spoke about finding the type of conditions which will tend to go our way much more than go against us. We looked at the moving averages. We looked at potential entries. We spoke about the idea of you've got to close your trades. You've got to take profit. It doesn't have to be at 1-to-1, but it does have to. It can't be forever. The market produces a huge number of 1-to-1 trades, fewer 2-to-1 trades, even fewer 3-to-1 trades, and that's like 98% of all the moves. Then you get the last 2%, which is 4-to-1 or 5-to-1 or more than that. And if you're looking for that, then it's more of a gamble, because then you're just looking for things that might happen but probably won't happen, and that's more gambling. When we're trading, we're looking for stuff that's highly probable, that's going to work in our favor. We're looking for the types of conditions that are almost certainly going to give us money if we keep looking for those types of things, or go our way, not give us money, but go our way. So what I'd like you to do, please, is I would love for you to register for the next webinar. I realize it's in between the holidays and the new year, but there's a reason for this. We're going to review what has happened over 2023 so that we can make a plan for 2024. So that when January comes around, you have a plan. I'm not going to leave it too late. It's better time to do it now, than not. Okay, we really want to let's talk about what's happening this year. Where were the opportunities? Could we have seen them? Could we have taken advantage of them? Where were the clues? As I was going to say, for example, I spoke about the fact that I had a live trading account. Oof, here we go. Come on. So for example, this is a live trading account, and you can see the difference here. For example, right now, like recently, it's been a bit of a drawdown, but the leverage is very low. So you have to cut as soon as you're kind of exposed too much on positions. But it kind of gives you an idea here of what sort of real trading is like. In terms of that, it's been for me, I have found that 2023 has been a phenomenal year, and I actually expect 2024 to be even better. So I did ultimately, at the end of the day, within year on year, I did 39% on this account, and I expect it to be I expect 40 to 60% in the coming year based off all the stuff I've seen so far. I was expected to do higher this month, but it's fine. It doesn't matter. And the market's going to go to, it's fine. I always make it back up, so I'm not too worried. We get these corrections and then you just go. And so one of those things that I've spoken about is whether I decide to sort of offer this service as a copy trade. The beauty is that the way that I trade, everything has a stop loss and there's always a cap, a maximum drawdown. So this has over the worst drawdown ever was minus 9.5%. And the high was 40% on the year. And that's, like, as far as I'm concerned, you should be making money every year, because if you're trading with the markets, whether they're going up or down, that should be the case. Okay, so I want to show you a real account, kind of show you what the case is. I'll be looking into the copy trading services. I'm more of a traditional type of person. I want to make sure that you never lose money in the long run, that you're always growing money and making it. But it doesn't mean that every month is going to be perfect. Minus 2.1, minus 2.8, but followed by phenomenal months, 10 and 11. So in the long run, the trading is actually getting better over time. So I wanted to just show you that quickly. And so in the next one on the 20th of December, the goal here is to cover trading opportunities that have occurred obviously in the last year. We'll look at the strategy as well and apply it, but mainly which markets to be looking at for January and February, because obviously if we do more of these webinars, we'll be doing them on a regular basis so that you can see these opportunities through our eyes as well. Even if you don't want to engage, you can just watch from the sidelines. But the idea is that I don't want people to feel that they're missing out on these opportunities. And I also want to show you how technical analysis is an incredibly powerful, reliable way to find real, like probable and profitable opportunities in the markets. So Hugo, how are you doing? I'm going to hand sort of back to you. I think that's everything for now that I can think of.
You cover all the material. I mean, you explain really, really well all the trends and how to, to find opportunities in different correction into the trend. Yes, I would like just to mention we've been tracking for copy trading provider, and I'm happy I found Adam. Yes, because it's a reliable copy trader. Well, you can find unbelievable profits around the internet, but at the end of the day, what is count is in the long term and the risk management he's taking, no? Because it's very easy to just to be lucky and make a really good profit in 2 months time, yes. But after a while, you will realize that you cannot support that in the long term.
It's got to be repeatable, sustainable. Very important.
Exactly. It's easy to get, if you are taking the risk, even if you never did trade before, it's like just throw one coin. You can win or you can lose. Yeah, but in the long term, at the end, you have to keep something that's mathematical support your trading, no?
Yeah, exactly.
Okay, Adam, really good. We keep again on the 28th, okay?
Yeah, so absolutely. So I'll be sending the links through to everyone to register between now and then. And I realize it's in the holidays, but it's like, again, think about this. It's let's review where the opportunities where it's 1 hour of your time, and then obviously the whole idea is that you can have a plan going forward. So in January, when the gates open, first week of Jan or second week of Jan, you actually know which markets to look at and what you're looking to do.
Excellent. So thank you to all the attendance, and I wish a really good Christmas time. So hopefully see you soon.
Yes, guys. Thank you. Have a great holiday, by the way. We'll see you next week. Thank you.